Okay, a very short question, but an important concept. This is from, again, IFRS 9. And actually, this is about interest-free loan between the parent and the subsidiary. It's not a very difficult question, but there is one concept which I want to explain, because sometimes students, they just get confused that why they are doing this treatment. So I would like to answer this why. So it says on 1st April 2017, Epsilon loaned $1 million to a subsidiary. The loan attracts no interest, interest-free loan, but is to be paid back in full in a single payment on 31st March 2009, which means that time period is 2 years. So it is for 2 years. The market rate of interest for a 2-year loan on both of the above dates is 6% per annum. At a discount rate of 6% per annum, the present value of $1 receivable in 2 years' time is $0.89. So this is parent, which is Epsilon, and the parent is giving $2 million loan. Sorry, $1 million loan for a period of 2 years to its subsidiary, and it is interest-free loan. And the subsidiary will return back 1 million after 2 years. So you know that we cannot ignore the time value of money. So the parent will have a financial asset, a receivable, a loan receivable, financial asset, and the subsidiary would have a financial liability, which they have to pay. And the financial asset which we have, we should be recording it at its present value. We are not going to receive any interest, so there is no need to discount the interest because there is no interest chargeable. It's interest-free loan. But we do have a discount rate, which is 6%. Interest rate in market is also 6%. Discount rate is also 6%. So what the parent need to do now here in the parent's book, we need to record the financial asset at its present value. I would call it debit. Financial asset, and credit, bank. So from the bank account, actually what will happen, from the bank account, what will happen that 1 million will go away out, okay? That is for sure because we are giving away 1 million. So I'm putting all 6 zeros just for the sake of clarity. Financial asset, we have to record it at present value at 6%, okay? So they have told us the present value. It says that $1 receivable in 2 years' time is 0.89. So you can say that, okay, this 1 million multiplied by 0.89. So this is the present value of the financial asset, which is 890,000. And this side, debit side, is actually lacking. And what we need to write down here, we will call it investment in subsidiary. Now, this is the concept that why are we making a debit to investment in subsidiary? This is what I want to explain. We'll say 1 million minus this 890,000. So 110,000 will be investment in subsidiary. This is what will happen on 01/04/2007 or 2017, which is the date of the transaction when the loan was given. When you get to the end of the first year, which is 31/12/2018, the parent needs to record or book the finance income. Here, the concept will be that the parent will have finance income, okay? Again, you might be asking why finance income? So I will give you the answer of these two why. This is one why. And the another asset, is why we are going to record finance income. So anyways, what will happen that 2 million, 1 million we have given, which we expect after 2 years. But in terms of today times 0, we record it at 890. And now we need to do unwinding. I'm sure you people are very much familiar with the concept of unwinding. So we will add up the interest, and here it will be called interest income or finance income. So parent will make a credit to finance income, which will be this amount, 110,000 multiplied by 1.06, okay, 0.06, 6%. Sorry, 890,000 into 0.06. And here it would be debit financial asset with the same amount. Now the financial asset in parent's book have become 890,000 before and 53,400. So the closing value of financial asset in the books of the parent would be this amount, which is 943,000. In the statement of financial position, the total financial asset would be reflected as 943,400, which includes the initial present value plus 1 year finance cost. And then comes the next period, which is 31st of December 2019. We need to repeat this transaction again, but of course with different numbers, because for the second year, we need to book the interest. This time we will say 943,400 into 0.06, the total, whatever is the total amount, okay? And here it comes like this. Now, if you see the financial asset, which is now at the end of second year, your total financial asset will be 943,400 plus 56, whatever, it becomes 1 million. You can see it is 1,000,004. This is because of some rounding off, but in essence, it is 1 million. So financial asset has grown in the parent's book. Initial 890, then added finance income and debit financial asset 53, then financial asset 56, it becomes, and then on this same day, the subsidiary would return back this money and you would say debit bank and credit financial asset. With 1 million, cash comes in, and 1 million, this one goes. You can ignore the 0.4. This is actually 1 million, okay? So what will happen? That your financial asset, which has been debited one time, then debited second time, and then debited third time. So this is total is 1 million. It becomes credited with 1 million. So financial asset is removed from the book, 1 million total. Similarly, you had a bank from where you paid out money. It was credited 1 million. Now the bank is debited 1 million. So the bank is also equal. If you visualize the net effect of this transaction is actually the net effect to this, your financial statements is debit, because this is not reversed. Investment in subsidiary, which is 110,000. And that goes on the debit side of the balance sheet, statement of financial position of the parent. And you have got this effect of credit finance income, which goes to your ultimately retained earning, because it goes to profit. From profit, it flows to retained earning, and retained earning is reflected on the credit side of your statement of financial position. So finance income, this one, plus finance income, this one. That makes it actually 110,000. You can ignore this $4. This is $4 is that rounding off difference, okay? So this is actually the net impact of this transaction on parent's book. 1 million goes out, and then what happens that debit investment in subsidiary on the statement of financial position, and credit side, it goes into the retained earning, that is equity. So the balance sheet is equal. Now, you might be thinking that why do we make this debit and investment in subsidiary, number one, and number two, that do we need to remove it or not? And if not, why do we not remove it? See, the question here is that the parent is giving interest-free loan to subsidiary. There is nothing as interest-free I mean, you cannot imagine getting $1 million interest free from parent or from anyone else. So if the parent is actually giving interest-free loan, so that is actually the parent is transferring some benefit to the subsidiary. As a result of this transaction, subsidiaries' profits would increase, because if the subsidiary had taken this money from a bank, they would have paid 6% interest. So they are not paying interest, but they are using this money. They are not going to, waste this money. This money will be utilized in the business, and that business that activity will generate some profits or some revenues, but nothing interest in the form of interest will be paid out. So it means that the subsidiary to whom I give this 1 million favor, their value would increase, because their retained earnings will increase, their profits will increase, their balance sheet would improve. And me being the owner, I reflect it as my investment in subsidiary, because now the subsidiary has grown bigger. Okay, so maybe the subsidiary before this transaction, if the size of the subsidiary was this much, after this transaction, the subsidiary has grown. The subsidiary has become bigger. So my investment, my stake, my asset has grown up with this number, because this is the benefit which subsidiary has gained, the 6% interest rate. And that benefit actually I have invested in subsidiary. So I call it as on my asset side, my investment in subsidiary goes up. Is it understandable? If I come back to, we were actually required to prepare parents' books, but we can also, just for the sake of clarity, we assume subsidiaries books. Now, the discount rates which we are using here is 6%. It is possible in reality that the subsidiary might have a different discount rate. And most probably it would have a different discount rate. But just for the sake of simplicity, we are using the same numbers. I'm going to use the same discount rate, 6%. So here what will happen? That subsidiary will have debit bank account, and they will receive in the bank $1 million. So I'm just, creating subsidiaries book so that you see both sides of the picture. Otherwise, usually it is not needed. Debit bank, and they will have credit financial liability. And if I use the same discount rate, which is 6%, they will be using the same number, like 1 million times 0.89, which was given in question. And then they would have credit equity. This is interest. This is important, that they will be showing it as part of the equity, because that increases their worth. So in the parents' books, this because the issue is 110,000. This is 110,000 is the benefit which is given for free, which is like a flow of, whenever there is no interest, the benefit transfers from the lender to the borrower. The lender is transferring benefit to the borrower. So for the borrower here, which is subsidiary, for them, their equity will go up by 110,000. And then on this date, they will make the transaction. They will call it, debit finance expense and credit finance liability, financial liability, with the same numbers. And then I don't want to continue. Later on, it will happen the same. The next year, again, the same transaction will be repeated at the end of second year. And when it will be repeated, but the numbers will be taken, this one, and this goes, this one. The total liability, the total financial liability will be 56 plus 53 plus 89, which is 1,000,004. And here they will say debit financial liability, which is 1 million, and they would say credit bank. They would pay out this liability by crediting the bank, and you will write down here 1 million. So subsidiary will also close its book. Subsidiary will remove the financial liability and balance out the bank account. What would remain in the subsidiary's books would be this equity amount. Equity amount 110,000 on their credit side, and they would have this difference of 110,000 because they received cash 1 million, but they paid out in terms of present value 190, so that would be the difference. So this is one concept of we call it interest-free loan. Whenever you give or take interest-free loan, and if it is for a period of more than 1 year, and in exam, naturally speaking, it will be more than 1 year. Because if it is less than 1 year, then you don't need to do finance cost or present value. Then you just say receivable and payable. If it is for 3 months, then you don't have to discount and calculate what is the present value of liability and then unwind it and do finance cost. If it is less than 1 year, you don't do all of these things. Then you will just say, I have received the money and it is my liability and I will pay it before the end of the year and go away. Nothing will be done like this. But that situation will not happen. If ever you will be given this question of interest-free loan, it will always be for a period of more than 1 year, most probably for 2 years. Even if you give it for 3 years, the same process will continue. I mean, even if it is for 10 years, the same process will continue. But the logic is this. So what you need to create is a financial asset. Investment in subsidiary. This part, investment in subsidiary in the parent's book, and equity goes into the subsidiary's book. So that was a short question, but an important concept.